Okay, welcome back. Let's dive right into this explainer. Now, we've spent a lot of time mapping out the entire Cyclo 3 framework, right? We've covered classification, pre-engagement setup, employee onboarding, contractor management, recurring payroll operations, accounting, internal controls, and of course, the risk and KPI framework. It's a lot. But right now, this is the exact moment that framework transforms from just knowledge into an actual real-world tool. We're going to look at how to take everything you've learned to diagnose a client situation, zero in on the exposures that actually matter, and deliver advice that literally changes how client operates. So here's our game plan for today. We're breaking this down into 4 stages. The 5-step diagnostic, spotting red flags in the field, pattern recognition through some real case scenarios, and finally, top process improvements. Let's get to it. Jumping straight into part 1, the 5-step diagnostic. This is your triage for the client's workforce. Think of these 5 steps as your ultimate field reconnaissance tool for every single U.S. client. Yes, even the ones who swear up and down they don't have any misclassification risks. Because honestly, most misclassification happens entirely by accident. Step 1 is mapping the complete workforce, employees and contractors together, tracking states and the cost split. Step 2, we review classification for every active engagement using IRS and state tests. Step 3 is verifying W-9s, which means acting on missing ones right now, absolutely not waiting until January. Step 4 assesses payroll compliance, like ensuring 401k remittances are handled within 7 business days. And finally, Step 5 is building that 3-way reconciliation framework, checking the payroll register against HR headcount and the general ledger, and separately verifying contractor year-to-date payments against the AP ledger and 1099 tracker. Now, fair warning. When you start running this diagnostic and asking for classification documentation, you are inevitably going to hear this exact phrase from payroll managers. Well, we've always done it this way. Listen to me, that is not a defense. Actually, scratch that. It's basically a giant flashing risk indicator. It almost always means nobody has actually looked at the compliance rules in years. Okay, moving right along to section 2, red flags in the field. We need to look at these symptoms not as some boring administrative checklist, but as critical, boots-on-the-ground observations. If you spot a contractor working exclusively for a client for 12 months or more, boom, elevated misclassification risk. No written agreement or statement of work? Good luck, their status is virtually indefensible in an audit. What if the client is offering benefits to contractors? Stop right there. That is the absolute strongest indicator of misclassification, and you have to reassess immediately. If you see payroll rising faster than headcount, you're likely looking at unauthorized pay or ghost employees. And if COBRA notices aren't documented, that's a quiet, invisible penalty of $110 a day per beneficiary just stacking up. All right, section 3, pattern recognition. It's time to see what good advisory actually looks like in the emergency room. Let's run through some rapid-fire scenarios to test your confidence. Case A, the number 3. Imagine a contractor who has been working exclusively for a company for 3 entire years with absolutely zero written agreement. See, a truly confident advisor spots this control failure and immediately hits the brakes. You literally stop new payments pending a legal review. You've got to apply the IRS permanency test and the DOL economic reality test. And heads up, you might even need to calculate back FICA and FUTA taxes here. Going forward, the prescription is setting strict 12 to 18-month maximum limits on these engagements to force a mandatory reassessment. Okay, case B, $8,000. You've got a contractor who was paid $8,000 during the year, but the client entirely forgot to collect a W-9. This is a classic painful mistake. Because there's no W-9 on file for a payment over $600, the company itself is now liable for a 24% backup withholding. Do the math on $8,000. That is a $1,920 liability sitting squarely on the client's shoulders. Your advisory response? Mandate a completely non-negotiable rule right then and there. Absolutely no payment is made and no one gets entered into accounts payable without a W-9 on file. Period. Case C, 18%. You're reviewing a payroll run and the total is 18% higher than the previous month. But there are 0 new hires. This scenario right here, this is the true test of an advisor. It is incredibly uncomfortable to hold up a payroll run when everyone is stressing out. But stepping in and saying, we're not approving this until we can explain every single line is exactly what separates a good advisor from a great one. You have to halt the approval. Do not release that payroll until every single gross pay increase is matched against an approved HR change authorization, the system rate, and a timesheet. You mandate a fully documented variance analysis for any change from the prior period. It's doing exactly what the framework demands. Moving to case D, the client just opened their mail and found a CP 2100 notice from the IRS. We're talking 1099 NEC, taxpayer identification number, or TIN mismatches. You've got to move fast here. Your intervention requires sending a formal B notice to the contractor within 15 business days to get a corrected W-9. If they just ignore you for 30 days, you must initiate backup withholding on future payments. To fix the root cause, you implement IRS TIN matching during onboarding and annually before you file 1099s. Case E is a massive exposure scenario. 12. A client in California has 12 contractors actively under investigation by the Department of Labor. So California uses the incredibly strict AB5 ABC test, right? And parts B and C are notoriously hard to satisfy. You must engage California Employment Council immediately. You need to start preparing to calculate minimum wage, overtime, workers' comp, and those severe PAGA penalties. We're talking $100 per pay period for initial violations and $200 per pay period after that, calculated all the way back to the date of misclassification. It's huge. Last scenario, case F. A terminated employee has somehow continued to appear in the active payroll runs for 2 whole months after they left company. Obviously, first up, you issue a formal demand letter to try and recover those funds. But the advisory play here is fixing the systemic failure. You need to implement a mandatory SOX-style control where HR notifies payroll in writing at least 5 business days before any run, complete with a second-person verification. All right, that brings us to our fourth and final section, top process improvements. Once you've diagnosed the symptoms and treated the immediate trauma, you have to prescribe the cure. If your diagnostic reveals gaps, these first 5 structural fixes are your non-negotiable starting point. You need a formal classification policy with documented tests, W-9s collected before any payment is ever made, a year-to-date contractor payment tracker updated every single AP cycle, IRS TIN matching done 60 days before January 31st, and absolutely separate general ledger accounts for employee versus contractor expenses. These steps structurally block the root causes of misclassification and backup withholding issues. And rounding out our top 9 improvements, we lock down those internal controls. We're talking dual reviews on all new employee setups, strict period-over-period payroll variance analysis before anyone hits approve, a mapped-out tax deposit calendar with automated reminders, and automating 401k remittances so they trigger exactly on the payroll date. So what does this all mean? Well, remember, Cycle 03 doesn't just live in a vacuum. The workforce costs governed by everything we've just talked about feed directly into the revenue and collection cycle from Cycle 01 and the procure-to-pay framework from Cycle 02. The clients who get all 3 of these cycles right, they're the ones with accurate financial statements, rock-solid compliance positions, and a workforce structure they can easily explain to any auditor who walks through the door. If you bring the confidence to pause a payment, hold up a payroll, or challenge a classification, you make that level of operational excellence possible. So keeping this powerful toolkit in mind, how are you going to apply this in your very next client meeting?